Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinuthalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Regular listeners of our podcasts and regular readers of our notes would remember the central theme of this year's outlook. Our 2022 Outlook report, which we put out 12 months ago, was titled Catch 22. There, we said that should economic growth start to moderate and inflation appear to remain more persistent than initially expected, central banks in developed markets could face a dilemma, and that markets would see increasing chances of a policy misstep by the central banks. As we approach the end of the year, it is easy to notice that the central bank dilemma dominated financial markets during 2022, causing equity bond portfolios to post one of their weakest performances in modern history. What is surprising is that this same dilemma could continue into the first half of 2023. Especially during the first quarter of next year, central banks are likely to face inflation that is falling but still above target, and growth that is weak yet slowing. Given that most central banks have already increased interest rates significantly over the past several months, the response lag is likely to add to some confusion. This uncertainty is already evident in the way central banks have acted and communicated over the past week. The Federal Reserve, the European Central Bank, and the Bank of England have all slowed their rate increments from 75 basis points to 50 basis points. Central banks in Switzerland, Norway, Mexico, and the Philippines also slowed their rate increases. However, all major developed market central banks maintained their hawkish tone about the future trajectory of rate hikes. Of course, markets have their own way of building expectations on what central banks will do. Here, we see increasing evidence of building divergence. The consensus and market pricing reflects bets that the policy rate in the US will peak below 5% next year, and the central bank will slash rates by next December. We are of the opinion that should inflation start to cool off, there is little incentive for the central bank to keep their policy tight for exceedingly long. This would especially be the case if growth slowdown remains significant over the course of 2023. Only time will tell us whether central banks are right or market consensus is right. But for now, let's take the market narrative of peak policy rate and consider the implications for financial markets. So here we are considering the scenario of what happens when the Fed stops hiking. In general, when the US Fed stops hiking interest rates, both bonds and equities tend to do well. However, equities tend to underperform when concerns about growth are dominant. Especially when the yield curves are in deep inversion, as is the case now, equity performance may not be robust. We expect this scenario of peak Fed funds rate and deeply inverted yield curves to play out during Q1 2023. Accordingly, we see value in preferring bonds over equities during this period. However, beyond the first quarter of next year, we expect growth concerns to fade, allowing equity market performance to be strong in the latter part of the year. While we remain constructive on financial market assets over the next 12 months, we see the sequencing of asset class preferences as being particularly important. In short, the tension between what the central banks want to do and what markets believe the central banks can do will remain a source of uncertainty for markets. In the event market consensus is right and the central banks stop rate hikes, the outcome for both bonds and equities can be very bullish. Though the inverted yield curve, which is an indication of impending growth weakness, tends to constrain the equity market strength. However, once these growth concerns fade, equity market performance can be strongly positive. In terms of asset allocation, we see value in preferring bonds over equities in the near term till the growth concerns are pushed to one side. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinuthalapati, and I'll be back next week with another episode of Global Investment Insights.